The European Central Bank cuts rates as expected, but reluctantly, meaning more cuts soon remain in doubt. Australian housing lending jumps in April as rental property investors build up ahead of steam, while building work slows in New Zealand. That's coming up in our 5 Things in 5 Minutes. And then in our bonus deep dive interview, ANZ Senior Commodities Strategist Daniel Hynes reviews the OPEC Plus meeting earlier this week and its impact on the oil market.
The details suggest it should be broadly positive for the oil market, but clearly they were disappointed with the fact that those voluntary cuts will be phased out before the end of the year.
But first, in 5 and 5 with ANZ, the ECB became the first big central bank to cut rates last night, as expected. But ECB President Christine Lagarde appeared a reluctant cutter in comments after the 25 basis point cut to its key lending rates. Traders saw her hesitancy suggesting just one more cut this year, where previously they had seen 2. Here's Christine Lagarde in data-dependent mode.
I wouldn't volunteer that because, as I said, we are making a decision on the basis of the confidence that we have that we are on a path. But we will need, at each and every point in time, in the course of the next few months, we will need data and more data and analysis of those data to constantly confirm that we are on this disinflationary path.
ANZ's head of G3 Economics, Brian Martin, saw Lagarde's comments reinforcing the ECB's caution.
I think it's very clear that the ECB is not going to rush into rate cuts. The decisions will be guided by the evolution of wage data, services inflation, and indeed underlying inflation going forward. It was interesting that the ECB did cut rates despite revising up their inflation forecast for 2024 and 2025 by 0.2 percentage point. However, it is also very clear that the ECB is very much keeping an eye on the future.
And looking ahead tonight, we have key US labour market data. Markets were mixed after that ECB decision. The Aussie and Kiwi dollars were a touch firmer at 4 a.m. Sydney-Melbourne time. The Aussie up 0.1% at 66.61 US cents, and the Kiwi up 0.2%, albeit at a 6-month high of 62.01 US cents. Number 2, Australia's trade balance rose by $1.7 billion in April to $6.5 billion, following a sizable dip in March. ANZ economist Maddie Dunk says the shift was due to imports falling more than exports.
Imports were down 7.2% in the month, particularly processed industrial supplies. We saw quite a big contraction there, almost 20%. And then on the export side, we did see some moderation there too. So they were down 2.5%, and particularly commodities exports were quite weak. So coal, iron ore were both down.
Number 3, Australian housing lending jumped in April, up 4.8%, outpacing the 3.8% rise in March. Meanwhile, CoreLogic house prices rose 0.8% in May, to be up 2.9% so far in 2024. Here's ANZ senior economist Blair Chapman on the lending data.
We are seeing quite strong investor growth, especially in the states where we've seen price growth, so WA, Queensland and South Australia. And we saw strong investor growth in April of 5.6%, although we also saw a pick up in owner-occupier lending as well in the month of 4.3%.
Number 4. In New Zealand, the value of building work put in place fell 4% in the first quarter, driven by a 4.8% drop in residential work. ANZ senior economist Miles Workman says that comes off the back of weakening building consents over the last year.
What has been difficult is trying to gauge the timing of how this weak consents data will filter through into the activity data, partly because the construction sector became so overheated with all this domestic stimulus. We just didn't know quite how long the pipeline was before things would start turning. The 4.8% quarter-on-quarter fall in residential activity certainly backs up what we've seen in the consents data and suggests that some of those chickens have come home to roost.
Number 5. Taiwan's May CPI came in yesterday at 2.24% annually, close to the CBC's 2% target. Market expectations were for 2.14%. Here's ANZ economist Bansi Madhavani.
Taiwan CPI did surprise on the upside, but our view is that the central bank, the CBC, will not hit the panic button just yet. However, there is enough uncertainty to keep them cautious. Now, the upside surprise in inflation was largely on the back of sharp rises in vegetable prices, fruit prices, and also electricity prices as higher tariffs kicked in. And we expect that the impact of these factors will fade in the coming months.
Bansi Matavani there. Now, in our bonus deep dive interview, ANZ Senior Commodities Strategist Daniel Hynes talks to my colleague Alex Tarrant about the recent OPEC Plus meeting and the surprise windback of voluntary production cuts, which saw the oil price drop earlier this week.
Well, going into it, the market was expecting Saudi Arabia and Russia, who had implemented these voluntary cuts of about 2 million barrels a day, to extend those until the end of the year. Unfortunately, they announced, to the disappointment of the market, that they would start to phase out those voluntary cuts in the fourth quarter. And so, whenever you get a disappointed market, you get a sell-off, and that's what we've subsequently seen. But when you delve into the detail of the meeting, there were some positives. The more formal production quotas, which have been in place for a while now, were extended till the end of 2025. So any concern about a flood of oil hitting the market next year has certainly been reduced as a consequence of that. So that was a positive. And also there was some talk about all those quotas being increased for producers such as the UAE, who had built additional capacity over the past few years as well. That ended up being only a small amount being added to their total. So overall, the details suggest it should be broadly positive for the oil market, but clearly they were disappointed with the fact that those voluntary cuts will be phased out before the end of the year. And so it looks like until things settle down, which could take a little while, I think we're going to see oil prices under a little bit more pressure.
There are some doubts out there, though, that the production increases can actually occur. Do we just have to take the announcement at face value?
Yeah, well, the voluntary cuts themselves are a little bit different. They were implemented by Saudi Arabia and 2 or 3 other major producers who do have the ability to raise output relatively quickly. But outside of that, the other producers in the more formal agreement have been struggling to really raise their output. And look, when we looked at the market for the second half of this year, we actually saw it being relatively tight, despite our assumptions that OPEC Saudi Arabia would actually phase out those voluntary cuts. So from a fundamental perspective, the lack of growth from some of those other smaller OPEC producers, as well as OPEC only gradually phasing out that cut, we still actually see the market relatively tight. And I think that will come to the fore in the coming months. But for the moment, with that market disappointed, we're likely to see that selling continue.
How do you think this might affect other producers like the US? Because we've been talking about those rig counts falling and the impacts on shale there. What's the flow through to markets like that?
Well, I think that uncertainty and that apparent lack of support by OPEC would probably put some doubts into producers' minds, certainly in the US shale industry. As you mentioned, the rig count has been falling, and I think with that economic backdrop remaining rather uncertain as well, and we did see some weak economic data in the US this week, it does suggest that we'll continue to see that growth in US supply diminish. We were actually forecasting relatively flat US output this year, and if those rig counts continue to fall, then that could turn into actually an overall decline in US shale output in particular.
Daniel Hynes there, talking to Alex Tarrant. I'm Bernard Hickey. That was 5 and 5 with ANZ for Friday, June the 7th. Catch you on Tuesday with a review of that key US labour market data tonight and what it might mean for the Fed. Monday is a public holiday in Australia. Yay! This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.